Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did.
Hello, everyone. Welcome to our second live LinkedIn event. Today, we are continuing into our second live LinkedIn event called The Hidden Metric Behind Long-Term Shareholder Value. My name is Marwan Karami, partner of Fortuna Advisors, joined by Greg Milano, CEO of Fortuna Advisors. And we're excited to get started. So let's start. This is basically a continuation from our last live linked event where we discussed the concepts of economic profit, or EVA, relative to other traditional measures. And today we are presenting I'd say a superior measure to even economic profit, or EVA, despite how good that is. And it's superior for really three reasons. One, a better balance of driving performance while investing in the future. So you're managing both short-term and long-term objectives within a corporation. The second is that RCE tracks better in terms of total shareholder returns, or TSR, than EVA and other forms of economic profit and traditional metrics. And then lastly, RCE is simpler to understand, especially for non-financial managers, which becomes very important as you look to have a company adopt it, whether it's at the shop floor level or right up to the executive and board level. In our last LinkedIn Live event, we summarize some of our findings in an article we published in the Journal of Applied Corporate Finance that showed that by adopting economic profit, you were able to drive out performance as measured by total shareholder returns. Namely, that companies that adopted economic profit generated 4.7% more TSR than their peer companies and close to 7% more than the S&P 500, broadly speaking. And as a review, economic profit is basically the profit that you've actually generated and comparing it to the profit you could have generated elsewhere. And so it's really the additional profit that exceeds investor expected returns or profit. And that's your economic profit. So something that's positive means that you've created more profit than you could have elsewhere. Something negative means that you had a shortfall in what you could have generated elsewhere. And what makes economic profit so powerful is it captures growth, margin, and capital productivity. But there's more that we can do in terms of enhancing this metric. And although economic profit and EVA have done a pretty good job of measuring value creation, there are certainly some major shortfalls and big problems that impact not only how it tracks to total shareholder return, but how it drives behavior as well. And in fact, I've got to hand it to my partner, Greg, who 25 years ago had identified those problems and was able to come up with a better measure.
Thanks, Marwan. So this page refers to an article that appeared in a periodical called The Evangelist, produced by Stern Stewart way back when, and it was provided to the companies that were EVA companies. And this article was actually an edited transcript of a speech I gave in Italy on this topic. And basically, there were two problems that I had noticed after about a decade of working with companies on EVA. The first was the measure is just unbelievably complicated, right? It's got a lot of potential adjustments to accounting, and it makes it very confusing for people. And it's hard to get people to really change their behavior and make better decisions when they really don't understand the measure. So that was the first problem. And the second, and I think even bigger problem, was it tended to discourage investment in the business. And that means both investment in growth and investment in replacing old assets with new assets that are either more productive or less maintenance cost or what have you. EVA created this environment where people were very unwilling to invest. When people implemented EVA, they often got a boost to their performance in the first few years, but then because of the underinvestment, it often stalled, and that's why some companies, sort of stopped using it. So as far as it being complicated, if you look at Wikipedia, under EVA, you'll see that there are up to 160 potential adjustments to accounting that can be made to align the measure with a particular company. Now, in practice, many companies use far fewer than that, but still some use as many as 10 or even 20 adjustments to accounting. And frankly, it just gets very confusing, even for people that know accounting, to keep track of it all. And that just really reduces the likelihood that somebody's going to really use it to make decisions. Now, with our measure, which is called residual cash earnings, or RCE, we deliberately made it simpler when we designed it, right when we founded Fortuna Advisors back in 2009. There are up to 3 accounting adjustments that are made, and some companies only need to make 1 or 2 of these. The first is the most important one. It's depreciation. In EVA and traditional economic profit, we depreciate assets, and so you charge for depreciation, and then it's the net assets, net of accumulated depreciation, that you have a capital charge. In our framework, we don't charge for depreciation, and we add back the accumulated depreciation, and I'll explain what that means. It's very important in a few minutes. The second is we capitalize R&D. Now, EVA allowed for capitalizing R&D, but a lot of measures of economic profit don't. And R&D is just one example of an investment in the business that accounting treats as a period expense. And so you get a better sense of the value a company is creating when we capitalize R&D and other things like brand building, marketing, and training, and things like that. We could treat the same way. And so we capitalize R&D. We don't charge it against earnings, and we capitalize it as part of the asset base that you have to earn a return on. And the same with leases. We want to capitalize off balance sheet operating leases and not charge people for rent, but rather give them a full capital charge on those leases. Although with the changes in lease accounting in recent years, fewer companies need to make any kind of an adjustment like that. So for many companies, it's down to 2 possible adjustments, and where there's no real R&D or other big intangible expense, it's really only depreciation. It's just far simpler than EVA to explain to people, especially non-financial people. So the measure is portrayed here, much like Marwan did a moment ago with economic profit. We start with something we call gross cash earnings, which is a term we made up to make it different from other things that people would already be used to. But essentially, it's EBITDA, add back the R&D if there is any, add back the rent if there is any, subtract tax, and that gives you gross cash earnings. And then you get a capital charge on the gross assets, just like you do with economic profit, except the gross assets have the accumulated depreciation added back, and they also include any capitalized R&D or capitalized leases. And so assets don't sweat away over time. They sort of stay there, which is consistent with the idea that you don't get charged for depreciation or R&D or rent. What's left over is RCE, or residual cash earnings. And as we're going to show in a little bit, the changes in residual cash earnings correlate really well with total shareholder return, which of course is our objective. In traditional economic profit, you get charged for a new asset in 2 ways. You get charged for depreciation, and you get charged a capital charge, which when you first buy the asset is very expensive. Then as the asset ages, that capital charge declines and it gets cheaper. And then once it's fully depreciated, it's free. So before we go on to seeing how RCE is different from this, it's easy to see how it's hard to come up to decide to invest in new assets when they're the most expensive the day that you put them in place. And every day that you just sweat old assets, you get this illusion of creating value because the capital charge keeps getting lower and lower. And once something's fully depreciated, I mean, barring a big crisis, there's almost no incentive to ever replace it, no matter how old and inefficient and unproductive it is. And so this is what we witnessed in companies was underinvestment in both growth investments and in replacing old assets. And that behavior we noticed, back at the time when I wrote that article, but the actual cause of it wasn't obvious to me until a few years later when I was at Credit Suisse working with Holt. Cash flow return on investment doesn't depreciate assets. And that's what gave me the idea to test an economic profit measure this way. And it just has worked out incredibly well. So thanks to the people at Holt.
Yeah, I recall when we had an engagement with an oil and services company where it created some really bad behavior, where they had assets that had been totally depreciated in one yard. They had capacity to use those trucks in other yards, but they never transferred those trucks to other yards because the yard that had the depreciated asset never wanted to give it up because there was no cost to its P&L. And so the new yard, or the yard that needed more capacity, ended up buying more new trucks. which is kind of the opposite of what you want. You want those people to transfer those trucks to somebody who needs them, but it created a lot of problems. And I recall how much of a difference it made when we just made that one simple change to the metric. Huge difference in behavior.
Yeah, the behavior impact of this is really the big thing. So thanks for that, Marwan. So in residual cash earnings, we don't depreciate the assets, so you don't get charged for depreciation. Of course, on the accounting books, we still depreciate them, but in the calculation of RCE, we don't depreciate them. And so you get charged a flat amount, a capital charge on that gross asset from the first day, as long as you own the asset. It never goes away until you retire the asset. And so there's no incentive to there's an easier, a much more likely incentive that you're going to invest in an asset because the initial hurdle is much lower. There's much more accountability over time because you don't get this windfall from the capital charge just depreciating away. And as long as the asset's there, you just keep getting charged for that charge. So, there's really no, there's no problem with replacing old assets when it's time to do so. You'll be replacing this capital charge with a capital charge from the new asset. Now, and these figures on this page are actually from my book, Curing Corporate Short-Termism. The figure on the left here shows traditional economic profit based on a particular profile of profit and cash flow and capital charges that look like what we looked at on the prior page. And you can see in this particular case, the asset doesn't produce positive economic profit until year 4. And then in years 6 and 7, after the asset is fully depreciated, the performance goes through the roof, right? And so there's less incentive to invest in this asset because it takes so many years till it turns positive. If you're being, let's say you're being paid to improve economic profit, this asset, wouldn't be something you'd want to invest in, even though the NPV might be very high. It's going to hurt your pay for 4 years till it finally turns a positive economic profit. When you then run this same profit and cash flow through an RCE analysis with the same asset, you actually, in this case, get a positive RCE right from day one. It improves a little bit as the cash flows improve over time. And then interestingly, there's a dip in year 6. So as the asset gets old, instead of it skyrocketing, the RCE actually goes down a little bit. And the reason for that is that when the depreciation ends, taxes go up. And so that tax being charged against the RCE actually goes down. So there's more incentive to invest in this asset and then more incentive to replace it when it gets old and maybe it's not that productive anymore. The behavioral implications are just huge. To give you an example of this in detail, I'm going to walk you through an Amazon calculation, a calculation of 2024 Amazon RCE and economic profit, and compare the two so you can really see mechanically, what we're talking about. We'll start with the net operating profit after taxes, or NOPAT, which is an input to traditional economic profit and EVA measurement. And you can see we have the revenue, we've subtracted the cash operating expenses, depreciation, rent, R&D, and operating taxes, and we get to about 50 billion of NOPAT. When we look at the related calculation for RCE, calculating gross cash earnings, we're not charging depreciation, rent, or R&D, so we've got over 4 times the amount in gross cash earnings that we had in NOPAT. And then when we now look at the assets or the capital invested for economic profit, we take the operating assets, subtract the non-interest bearing operating liabilities, and we get capital of a little over 300 billion, average capital of about 271 billion. When we do the same calculation for RCE, we start with the same operating assets, but now we're going to add back all the accumulated depreciation, all the capitalized operating leases, all the capitalized R&D. We'll still subtract those non-interest bearing liabilities, but now we've got gross operating assets literally almost 3 times the capital invested, right? Much more accurate representation of really all of what's been invested in the business instead of just expensing all those long-term investments on the P&L. And when we calculate economic profit, we get a positive 22 billion, but when we calculate RCE, we get a number that's about 6 times that high. And so, the value creation of this very successful company, Amazon, with this phenomenal total shareholder return over the years, is much better represented with RCE. Now, this point can be made this way, or it can be made by looking on the next page at how this relates to value. So if we flip to the next page, these 2 figures are from an article in the Journal of Applied Corporate Finance called Beyond EVA. And in there, we analyzed Amazon's valuation using both traditional EVA or economic profit and using RCE. And the simple valuation model we used here was to capitalize the metric. So capitalize EVA or capitalize RCE, just divide by the cost of capital. Take that present value of a sort of perpetuity of today's performance, add it to the assets of the business, however they're calculated for each company, so for each metric, subtract the net debt, divide by the number of shares, and that gives us a spot value of the company. And you can see in the case of the EVA implied share price, the estimated valuation is around $500 a share in the last year of this graph, where the actual share price was like $1,000 higher than that, plus or minus. And you can see in all the years, the EVA woefully underestimates the value of the business. When we do the same analysis with RCE, for many of the years, we're right in the middle of the range. Just simply capitalizing RCE, adding it to the assets, subtracting the net debt, dividing by the number of shares, gets you pretty close to the share price of the company. There are a couple of years there in the early periods where it's a little bit low, but you can see for the vast majority of the period, RCE tracks a company like Amazon really well. And there's one other point on this page that's worth noting. Many companies have two different types of business models. Like, for example, a retailer that might have some bricks and mortar retail. Then they have a separate division that's a direct to consumer online business, much more like Amazon. And all the traditional measures of EVA and economic profit and return on capital and so forth were really geared more toward analyzing the bricks and mortar type of business. And they do a pretty bad job of analyzing the Amazon type of business. But when you use RCE, it allows you to compare these two different types of business models in a way that is much more balanced. And so you get a better sense of, where you should be allocating more resources and so forth. And we have a forthcoming case study we've been developing, which I'll just give you a preview to, where we look at a hypothetical company back in 2012 that had two business units, one called Walmart and one called Amazon. And if you look at almost every traditional metric you can imagine, it would have told you to pour all your resources into growing Walmart, except for RCE. RCE would have told you to pour all your resources into Amazon. And as we can see from what happened since then, that would have been really the right decision. In that same Beyond EVA research report, we ran an extensive, more than a decade research study to look at the relationship to TSR of these two metrics. And without getting into all the details, as explained a lot in the article, RCE tracks total shareholder return better than EVA in every industry. And I think that's really important because at the end of the day, we're trying to grow the total shareholder return of the company to be hopefully in the top quartile. And we just have more of a likelihood that that's going to happen if people are making decisions to improve RCE than they are if they're making decisions to improve any other measure, even EVA. One practical example of this, just to illustrate from a real sort of case study we had with one of our clients, when we worked with them, they said to us, we use return on capital, and we find sometimes we have to make quote unquote strategic decisions when the numbers don't look right. And this was an acquisition they had looked at that didn't turn, the return on capital didn't turn above the cost of capital until year 5. And they said, we had to say this was strategic because our acquisition criteria call for achieving a return on capital above the cost of capital much quicker than that. And they had tried to use EVA to apply to this, and basically the same story, right? It doesn't turn positive until year 5. Well, we ran that exact same forecast, the same Excel model that were used to produce those two graphs through RCE, and we got an almost immediate benefit, much lower in the first year because there were a lot of transition costs of integration and so forth. But then once you got to steady state, it was producing positive RCE right from the get-go, and it kept improving. So, if you ran out the forecast of the EVA trend longer with the assets depreciating away and so forth, you'd get to basically the same net present value. But RCE reflects that value more evenly over time, and return on capital and EVA tend to show things looking bad when they're new and looking great when they're old. And that's really, again, where the real behavior problem comes.
Yeah, I think a lot of times to build on that, many companies just think that if they use return on capital, that would be good enough. The problem with return on invested capital, it only measures quality, not quantity, and that actually applies to any percentage measure, like margins, for instance. One of my favorite examples of this is the following, which let's just assume you have a business, an existing business that's generating revenue of $3,000. You've got gross cash earnings of $450. So just to work through the math on this first example here, take the 450, divide by the 3,000, you have 15% GCE margin, very similar to EBITDA margin. And then looking at the gross operating assets, the capital you've got invested in business of $10,000, if you divide the 450 of gross cash earnings by the 10,000, you get a return on invested capital of 4.5%. And for RCE, it's basically a cash on cash return on invested capital, which I think does a better job of even measuring ROIC. In any case, let's just now assume, using the same math, you've got an investment opportunity where revenue is going to grow, your gross cash earnings is going to get higher, your margins are even better at 24% versus 15%, and your return on invested capital increases from 4.5% to 8%. You can see that if you are incentivized or if you're making decisions based off of GCE margin or return on invested capital, your decision's probably going to be, let's go ahead with this. But if it was your own money that you had put at risk, and looking at the existing business, you realize that you could have gotten a 10% return because that's your cost of capital. And so your capital charge of $1,000 really represents $1,000 of GCE you could have invested elsewhere that would give you a 10% on the $10,000. You can see that your shortfall of profit was 550. That's your residual cash earnings of a negative 550. If you had to do it all over again, you probably would not have invested in this existing business. But you can't cry over spilt milk. So we're always looking at sort of the growth and the improvement of RCE. For this new investment opportunity, although it's generating 8% return on invested capital, it does not exceed your opportunity cost of 10%. You could put that money of $3,000 elsewhere that would give you a 10% return on invested capital, which would generate $300 worth of gross cash earnings versus the 240 that you have here. Alternatively, let's just assume now you've taken that company that had $10,000 worth of gross operating assets. You were divesting assets that weren't producing as much return as it should have. You have now maintained the same revenue, so doing more or doing the same with less, but actually creating more profit than you could have otherwise. Here, you can see that the gross cash earnings margin is 30%. Your rate of return here is 22.5%. Now you have an investment opportunity that's going to generate more revenue, but lower GCE margins and lower rate of return. And so despite all these metrics actually looking like this might not be a great investment, if you're an owner of the business, realizing you could get a 10% return in terms of your next best alternative, your existing business is doing phenomenally well. And the fact that you're investing in an opportunity that's going to give you a 13% return, although lower than your existing business, still exceeds the required return. And so the RCE is always going to give you the right signal in terms of whether you should invest or not, and what your decision should be. And what I love about this concept is it dollarizes returns in a way that fundamentally makes intuitive sense. You know for a fact that percentages like margins and return on invested capital don't pay the rent and they don't pay bonuses. It's the dollars that do. And so one of the biggest benefits of residual cash earnings is it dollarizes returns in a way that takes into account both quality and quantity.
Just to add to that, Marwan, so a lot of times it's important to tie these metrics into executive compensation. And in this case that we're looking at here, if somebody had made this good investment, they would have made less money. And that would be unfortunate because the company's better off with this investment. The shareholders are better off. Why shouldn't the management and their families be better off? That misalignment is really problematic. And on the prior page, which we don't have to go back to it, but on the prior page where the margins go up and the returns go up, but the RCE goes down, for people in most businesses, they assume the incentives are designed to encourage them to do what the company wants them to do. So if people looked at the end of the year and said, wow, our margins went up and our returns went up and we got paid more, they'd be cheering. They wouldn't be saying, oh, wow, we slipped one by. They'd be cheering, saying we did exactly what they wanted us to do. They wanted us to grow margins. They wanted us to grow returns. It's just so much easier to get people to do the right thing if you align them with a measure that tends to go up when value is created and tends to go down when it's not. And rates of return on capital and margins are just really flawed in that regard.
Yeah. And it's because these measures, although important drivers of value creation, they don't necessarily tell the whole story. And so a lot of companies end up adopting a lot of different measures, try to, incentivize people on these multitude of measures. And the question is, if two goes up, one goes down, which one should you maximize? Which is the one that ends up acting as the arbiter in terms of the decisions you make? With residual cash earnings, if you're focusing on the improvement of RCE, you can apply it to goal setting, strategy and planning, pricing, all these different applications within an organization, both strategic and tactical. And it's largely because it provides that better insight and that common language that could be used with throughout the whole organization, different functions and at different levels, that then provide better decisions that can be made faster because people are speaking the same language. And then when you adopt it from an incentive standpoint, that drives better behaviors, making what's good for the company investors also good for employees and their families. Now, if you want to learn more, we are offering a free copy of the Journal of Applied Corporate Finance, which we're proud to say actually honored our thought leadership over the many years. Each of these articles are articles we had published. And all you need to do is just email us at info@fortuna-advisors.com and put in the subject JACF request live LinkedIn. We'd love to hear from you in that regard. At this point, maybe we can take a look at if we have any questions, or maybe even talk about some of the questions that were often asked when looking at it.
Here's a question. So we've used EVA before and people didn't really understand it. How can we make sure people know what it means and how to use it to make decisions? And like any other, sort of change management program, implementing RCE requires training, requires proper communication. We tend to help companies to change the way they plan, the way they budget, so that RCE becomes a featured part of it. It allows you to bring the capital budget, the R&D budget, the P&L budget all into one, which is really helpful to decision making and trade-offs. But really making sure you do really understandable communications and training. We don't have to teach people how to calculate the cost of capital, but we do want to teach them things like, what if a customer says, I want to pay you in 90 days instead of 30 days? How much would the price need to adjust in order to be neutral on RCE? Or if somebody says, I want to buy, a second, production line in order to increase volumes, what sort of volume and pricing would I need in order to make the cost of capital, in order to cover the cost of capital on that line? We want to, depending on what function people are in, we want to communicate to them what the measure is all about, the kinds of behaviors that we want, and get very specific about how they can use it to make the kinds of decisions, that they're familiar with. And we even sometimes do what we call value creation action teams, where we work with a group of people in a function like procurement or in a business unit, to try and identify opportunities for improving RCE, help them with the analysis so that they can really see how to use it. And it's kind of like training wheels. And then after they do that for a while, you can stop having those meetings because people just learn to consider that as a normal part of their operations. And it really builds financial acumen like nothing else I've ever seen. It really gets people thinking and acting, more like owners.
Yeah, I one particular decision case that I found was pretty innovative. A lot of companies become very innovative in how they apply it. Was an industrial, diversified industrial-based company that had huge amounts of accounts receivable. They wanted to hire a new finance person basically to do the collections, and HR was trying to figure out a way of whether it made sense or not. And they came up with the idea of looking at how much accounts receivable they'd have to bring down to cover the cost of that new accounts receivable clerk or employee. And it's that kind of innovation where you realize there's a lot of value to be made that people typically don't look at because they're always focused on the P&L and not the balance sheet.
Another question is, how does this affect investor relations? Which is kind of interesting. We've been only talking about the internal use of this, but obviously for a company that embraces RCE as a way of running the company, a way of running planning and decision making, resource allocation, and incentives, you'd probably want to explain to people what you're doing. Not everybody communicates the calculations and the result of their RCE publicly, but most companies that have done something along these lines do, at least during the period when they're initiating it, communicate to the investors what the metric is, how they're using it, and they try to give examples of, this is how we'll use it in capital allocation, and this is how it will create discipline in our acquisition process, and so forth. So it's the behaviors that they're trying to get the investors to understand. Not necessarily all the details of the calculation, although many companies do also publish the result of the calculation as well. I guess sort of related to that is a question: what about ISS and Glass Lewis? They're the proxy advisors that review, executive compensation and other things, and advise investors on that. The question is, how can we get something like this through their review? And many of you probably know this already, but in 2018, ISS acquired EVA Dimensions, and so they already have a sort of stake in the economic profit world. And as we said, really prior to this, in the prior LinkedIn Live event, we think, EVA is way better than, the vast majority of metrics that people use. We just think our measure is even a little bit better than that. But because of the logic behind RCE, because of the logic behind how it motivates people to do the right thing for shareholders, we found both the investors themselves and the proxy advisors to be, very positive when companies embrace these kinds of frameworks. And so, this is a positive in their eyes, not a negative at all. I guess one other question is, this seems only focused on shareholders. What about all the other stakeholders? In 2019, the Business Roundtable here in the U.S. announced that the objective of a public corporation is no longer just to maximize shareholder value; it's supposed to maximize the outcome for all stakeholders. And I think what we find is the companies that care a lot about all their stakeholders, their employees, their customers, the communities in which they operate, their vendors, tend to produce a lot better RCE and a lot better TSR. And we've published research to this effect. One article published on CFO.com is called, when companies do well, they also do good, showing that companies that are in the Fortune Most Admired Companies list and the Forbes Just 100 tend to produce way better performance for their shareholders. And, we think that trying to maximize RCE and trying to maximize total shareholder return requires you to think about what's good for all my other stakeholders. In the short run, you can skimp on doing things for some of your stakeholders and probably produce, some results out of that. But in the long run, you just can't do it. You have to care about the good of your stakeholders in order to produce shareholder value. And so we think this is very aligned with the stakeholder approach as well.
Yeah, I think the measure itself embodies the fact that, everybody gets paid before the shareholder does. So if you're satisfying everybody else, the residual really goes to the shareholders after paying for taxes and the employees and the suppliers and the customers, all those type of things get embodied in that one measure. So what's left over has already taken into account all the stakeholders.
Good point, Marlon. Let's just answer one more question. Do boards and compensation committees like the approach? And I'll be honest, most board members tend to be, often at least, they're retired executives from companies or investors or other experts. Very often they didn't sort of go through their majority of their business career thinking about metrics like this, so it's new to them. So just like it requires some communication and training to educate the employees on what this means to them, the same is true for the people on the board. They need to be familiarized with it. They need to understand the kinds of behaviors it's going to encourage. They need to see sort of examples of that. They need to see that other companies have done it, and they need to see the research showing that companies that have embraced some form of economic profit have outperformed the market by 7% a year. And we've never seen a situation where a company designed a framework like this and it wasn't approved by the compensation committee. But it does take some work. You can't just go to them and say, this is what we're doing. And they say, okay, that's fine. They have to understand it. But once they understand it, they tend to be very smart people. That support tends to be there. All right, Marwan, why don't we wrap it up there? I think this has been good. I hope it's helpful to people. And at this same email, info@fortunaadvisors.com, if people have comments or questions that you want to let us know about afterward, please feel free to do so. We'd be happy to entertain your questions.
Thank you for joining us.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.